Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. I'm Boyd Baker, and thanks for tuning in to another options tutorial. Today we're going to talk about a specific bull option strategy. And in the past we introduced the options ladder, and what we talked about were some of the more bullish strategies, such as buying a deep in the money call, all the way down to not a very bullish strategy, such as buying a long out of the money call. We talked about the vertical bull call spread on the last video, and today we're going to introduce the synthetic long combination. And what do we mean by a synthetic long combo? That's where you're putting on two bullish strategies at the same time, trying to get a delta equivalent closer to what a long futures might be. Typically, a synthetic long combo may be about 2/3 equivalent to a long futures, or about a 60 to 70% delta. So again, what we're talking about is buying a long call and selling a put at the same time. Now, your gain is unlimited to the upside. It's going to be very similar to a futures contract, but your loss is also unlimited. You need to stay on top of this strategy, similar to a futures, where you exit the trade if it's going against you. Now, you're going to put on this trade when you're bullish the marketplace, looking for a similar performance close to what the futures can give to you. But we're implementing it with options. And let's look at it on a chart and see what this looks like. This is the live cattle market. And prices have dropped down here into the 148, 150 area, and now look like they're attempting to rally. Now, if you're bullish the marketplace, one can consider buying a slightly out of the money call, and this is the 158 calls, and selling a slightly out of the money put, such as selling the 148 puts. The marketplace is right here in the middle at about 154. Now, when you sell this out of the money put, the delta equivalent is going to be about 30%, or about 30% long a futures. When you're long that out of the money call, the delta on a slightly out of the money call, we said it's about 30% also. So when you add up those two deltas, you're getting close to about a 60% long futures. So the margin on this is going to be about 2/3 of what a futures margin is. In this case, live cattle, it's about a $2,200 margin. If the delta equivalent here is about 60%, figure the margin to put on this trade is going to be about $1,500. So again, you're going to want to put on this strategy when you're bullish the marketplace, looking for upside potential, similar to a futures contract, but not having to post the full margin for a futures contract. Remember, it's going to be at two positions where you're selling the put to buy the call. If you have any questions, feel free to call me here at 866-973-2079.